Some 37 million Americans are bracing for impact as we prepare for the return of student loan payments. In March 2020, legislative and executive action pressed pause on student loan payments and it's accumulating interest. But the time has come to press play again. With national credit card debt topping $1 trillion, an uptick in unemployment, home prices, and interest rates high. And now's the time for the comeback of additional debt for millions of consumers. This could put a serious strain on the housing market. Before we jump into today's video, I have to ask you guys a huge favor. If you like this content and you'd like to see more of it, then make sure you smash that like button and subscribe to my channel. So we've got student loan payments on one hand and housing on the other. How the heck are the two related? I mean, the return of student loan payments is an additional debt for could-be homeowners that they weren't having to pay before. And more debt means less money to go towards a mortgage payment. So let me break this down for you. As a lender, when we're calculating how much home you can afford, we calculate what's called a debt-to-income ratio, or DTI. Your DTI is calculated by taking your monthly debts divided by your monthly income. For example, if you have $1,500 a month in debts and you make $5,000 a month, your debt-to-income ratio is simply $1,500 divided by $5,000, which is 30%. When we're doing the calculation, we're taking your would-be mortgage payment into account, and it goes into that calculation. I mean, with that being said, more debt could push some borrowers now out of the qualification zone. Or maybe they can't qualify for as much home as they previously would have. With the restart of student loan payments comes a bit of relief, as the Biden administration is providing a year-long on-ramp to help ease borrowers back into the repayment routine. So if you miss a month or two's payment between October 1st, 2023 and September 30th, 2024, you won't be considered delinquent and it won't be reported to debt collection agencies. Quick pause and a huge word of caution to anyone beginning payments but also looking to buy a house. Now, I've heard talk of mortgage lenders marketing to potential borrowers to ignore their first year of payments during this grace period. And instead buy a house? You think I'm kidding? I mean, if anyone is giving you advice, please run in the opposite direction. As a mortgage lender and someone who believes wholeheartedly in the power of real estate, I don't want this to scare you, and I want you to be able to purchase a home, but not if it disrupts your personal finances for the rest of your life. So instead of operating on fear, let's operate on data and strategy. There are ways to achieve homeownership on your own terms, on your timeline, even if you're making student loan payments. So here's 3 tips to help ease your mind. First, enroll in the income-based repayment plan. The Biden administration recently opened up a more affordable income-driven repayment plan called SAVE, which pegs the size of your monthly payment to your income and your family size. Income-based repayment plans are the best way to get a monthly payment that you can afford. Second, just because you have student loan debt doesn't prevent you from getting a mortgage. As briefly mentioned before, we're only looking at the monthly payment when calculating the debt-to-income ratio, not the sum of all you currently owe. And lastly, if you envision homeownership as part of your future, it's never too early to start planning. Contact a trusted loan advisor and run affordability scenarios. Curate a plan that you're comfortable with that will make sure you're set up for success when the right time comes. Well, that's all I've got for you today, guys. Thanks so much for tuning in, and I'll talk to you soon.